Welcome to Brookstone Financial. Today we will be discussing the benefits of having alternative asset classes in your portfolio. Before we begin, I would like to ask a simple question. Are we still near all-time highs or all-time lows in the stock market? That's right, we're still near all-time highs. The traditional method of offsetting risk in a portfolio has been to increase your fixed income or bond allocations. While historically speaking, bonds have brought stability to portfolios, the tables may begin to turn. There's never been a greater risk in investing in bonds because the value is sure to drop as the interest rates rise. Money markets and CDs have never paid less, as we are still near all-time lows in interest rates. So let's talk about some alternatives to stocks, bonds, and cash. Over the years, we have spent a lot of time researching how super high net worth individuals manage money, how pension plans, foreign sovereign funds, and endowments manage their money. Whether it's Harvard, Yale, or Stanford, we should all be paying close attention to how they manage their money. They all have very diverse portfolio allocations that include a whole lot more than traditional stock, bond, and cash allocations used by most retail investors. We refer to this type of management as the endowment model. The alternative allocation in the endowment model helps create a more diversified portfolio while potentially decreasing risk and increasing returns. This chart shows an example of traditional portfolio allocations versus alternative portfolios. Our clients buy real estate investment trusts for two reasons. The first is current income, and the second is growth. Typically, these types of real estate investments will pay you in the neighborhood of 5 to 8% in distributions per year. So, we like real estate for diversification. We like it for income, but it's also a great time to be buying real estate for the capital appreciation opportunities. The real estate market typically lags the overall S&P 500 3 to 4 years. So you're just now seeing a recovery in the real estate market, but it's still a great time to invest because the real estate markets have not fully recovered. Your typical real estate cycle or investment cycle goes from boom to bust to recovery to stabilization and back to boom, typically over a 15 to 20 year period of time. The bust started back in 2008, so now we're about 6 years in. We think that we've still got a nice runway of opportunity in buying real estate. Given you had the choice, would you rather buy a home today or back in 2006? Well, the best answer would be 2009. But since we can't go back in time, the right answer would be today. You see, real estate is still recovering, but it's not fully recovered. If you're considering alternative assets, such as real estate, for some of your after-tax money, there may also be some tax advantages from depreciation. In some cases, the monthly distributions paid to shareholders are 50 to 100% tax deferred. Finally, can anyone tell me, before the tapering began, just how much money the government was printing? Approximately $85 billion per month. So economists can tell you that at some point we're going to have higher inflation. The question you need to be asking yourself as an investor is, how do I diversify my portfolio for periods of higher inflation? Historically speaking, you want stocks, but you also want hard assets. Things that rise in value with higher inflation. An example of hard assets could be commodities like gold and silver. It could be basic materials like steel or aluminum or real estate. Rising interest rates and the potential for higher inflation are the reasons we use alternative asset classes like real estate in our clients' portfolios. If you like what you're hearing, you may also be asking yourself, how can I own real estate in my portfolio? Are you a wealthy individual that has the time, the money, or the expertise to buy and manage your own commercial real estate portfolio? If the answer is no, then we may have a solution. The investment tool that we have found most effective in allowing our clients the ability to invest in a diversified portfolio of commercial real estate is a real estate investment trust, or more commonly referred to as a REIT. Your biggest risk in investing in a REIT is liquidity. You cannot put money in here that you need next week, next month, or even next year. Based on the current market environment, this is probably a 3 to 5 year investment. It could be shorter or it could be longer, but you need to know that the principal may be unavailable for at least a 3 to 5 year time frame. That's why this is not for half of your portfolio. That's why it's not for 75% of your portfolio. Depending on your investment objectives, your time horizon, and your risk tolerance, this might be a 10, 15, or even 20% allocation in your current portfolio. Now, a real estate investment trust is like a mutual fund. You may already own mutual funds, and in mutual funds, you pool investor assets together to invest in a diversified portfolio with specific mandates. Whether it's large caps or small caps, international, technology, or a diversified blend, you are pooling assets with other like-minded investors. With real estate investment trust, our objective is to pool investors' assets together to invest in a diversified portfolio based on specific types of real estate. I want to stress specific type because they all behave differently. Office buildings are different than industrial parks, than healthcare properties, than shopping malls, than apartments. Before you consider real estate for a portion of your portfolio, you should be asking the following questions. What type of real estate is it? Do I understand it? Is it a good opportunity? The Real Estate Investment Trust was actually created under the Eisenhower administration in the 1950s because they wanted the retail investor to participate in the growth and the wealth creation associated with owning real estate. This investment vehicle now allows the retail investor to get institutional and professional real estate management. We can now further mitigate risk by owning a broadly diversified portfolio of real estate. This investment vehicle is appropriate to taking advantage of the growth and the income opportunities that exist in real estate. Now that you understand the basics of a REIT, I would like to explain the 3 distinct phases of a REIT's life cycle. Stage 1, the REIT is open to new investors. During this phase, as the money comes in, the REIT immediately begins to buy income-producing properties. Stage 2, the REIT pays a monthly distribution to shareholders. Stage 3, the REIT closes to new investors and begins looking for the best exit strategy to produce a liquidity event. A typical REIT portfolio will set out to sell $1 or $2 billion in shares. At some point, the offering will close to new investors when the shares run out. Now remember, this is a publicly registered, non-traded investment, so there are public quarterly filings, annual filings, and registration with the SEC. There's a lot of transparency, but they are still non-traded. That's why our biggest risk is liquidity. In the final stage of the process, the goal is to create a liquidity event on the REIT portfolio. This can be accomplished in one of 2 ways. The entire portfolio could be sold, or it could be acquired by a sovereign fund, an insurance company, a pension plan, or it could be a public real estate investment trust. Or there may be an opportunity to take that non-traded REIT and list it on the New York Stock Exchange or the NASDAQ. It then becomes an actively traded stock just like any other you may currently have in your portfolio. Hopefully by now you are starting to get the basics of a real estate investment trust and what they are and what they aren't. You may now be wondering, how do you know what real estate trust to consider as an investment? We prefer portfolios of real estate tied to necessity. What happens to approximately 10,000 people every day? They turn 65. The largest generation in history, known as the baby boomers, are just now starting to turn 65. 10,000 baby boomers per day will turn 65 over the next 17 years or so. Are we living longer lives at 65 or shorter? longer. Many people would argue that the greatest technological advancement of our lifetime is not your smartphone or the internet. It's the expansion of life expectancy. As a society, our life expectancy has grown approximately 20 years in just the last 50 years. It's been said that within the next 5 years that approximately 20 cents on every dollar we spend in this country will be spent on what sector of our economy? Healthcare. Many would argue that this is the best sector of our economy. So, as an investor, we want to take advantage of it. We like healthcare-related real estate. If you break your leg, you're not putting a Band-Aid on it, you're going to the hospital. As the population ages, the need for assisted living centers, adult daycares, and nursing homes will increase. The likelihood that the occupancy rates in these types of facilities will remain solid over the next 20 to 30 years is high. What about Obamacare? If Obamacare stays intact, 30 more million Americans will have insurance and use the type of facilities we're buying. If they rescind or appeal Obamacare, you can't fight the dynamics or the demographics of an aging population. 10,000 people that are turning 65 every day and living longer lives. Just like not all stocks are equal, not all real estate investment trusts are created equal. As independent advisors, we have the ability to inspect, to investigate, and then to choose only those that we feel bring the best value to our investors. More importantly, we know where not to invest. This best-of-class approach has served our clients well over the years. We have several REIT strategies that we are recommending currently. Although we can't guarantee success in any security, we can guarantee that you will benefit from our due diligence process that guides you to the very best opportunities available in this exciting world of REITs. This presentation is not an exhaustive dialogue on the subject. You need more information before investing in real estate. Our service to you will be helpful and educational. Contact us for a personal response to your important questions and our list of the best opportunities to invest in now. We are here as your guide.